Okay, think about the incredible power packed into the computer chips that run, well, pretty much everything these days. Your phone, data centers,
Mm-hmm.
AI.
Mm-hmm. Everything.
Right. Now, behind the scenes of making these tiny silicon brains, there's this company most people probably haven't heard of, but without them, none of it really happens. ASML.
That's exactly right. And for this deep dive, which is really tailored for you, our listener, we've gone through a pretty fascinating document, thesis ASML chatgpt.pdf, to really dig into why this company is so essential.
Exactly. So for anyone just tuning in, ASML is basically the undisputed king of photolithography
The
systems.
king, yeah.
Think of it like they build these unbelievably precise, almost magical machines. You absolutely need them to create the tiny brains inside all our electronics. It's sort of like shining this super focused light through a microscopic stencil onto special material on a silicon wafer, basically drawing the maps for computer chips.
And what's so crucial to grasp here is that this isn't just about, incredibly advanced tech. It's really about the future of innovation in so many fields.
Yeah, right.
Okay. So we're going to pull out the most important and, frankly, some pretty surprising insights about ASML's business, the unique, well, stranglehold they have on the market, their financial muscle, and the bigger picture, the industry they operate in.
Okay, so our mission today is pretty straightforward. Understand what makes ASML's business model tick, what gives them such a powerful, unique advantage, just how solid their financials are, and what the future might hold for them in this super fast-moving world of semiconductors.
Yeah, by the end of this, you'll really get why this one company is utterly vital to, well, basically all technological progress.
Okay, let's dive right in then, right to the core of what ASML actually does.
Okay, so at its heart, ASML's business is all about designing, building, and selling these unbelievably complex photolithography machines.
Right.
And what's really fascinating is their intense focus, you could even say laser focus, on this single, incredibly critical step in making chips, this specialization. That's exactly how they've managed to get this unmatched technological leadership.
And when we talk about their machines, we're really talking about different types, right? Each one sort of more mind-blowing than the last. Let's start with the top tier, EUV, extreme ultraviolet lithography.
Right, EUV. These are truly the cutting edge. They use light with an incredibly short wavelength, just 13.5 nanometers.
Wow, 13.5 nanometers, that's tiny.
It's incredibly small, and that's what lets chip makers create circuits, just, a few atoms wide, packing billions and billions of transistors onto one chip.
Mm-hmm.
And here's where it gets really, really interesting. ASML is the only company on Earth right now making these high-production EUV machines.
The only one. That's huge, a complete monopoly at the very frontier of chip tech.
Exactly.
So this single point of control basically means the entire advancement of leading-edge computing kind of hinges on ASML's innovation and how many of these machines they can actually build.
Pretty much, yeah. And these EUV machines, they're not just fancy equipment. They're absolutely essential for making the most advanced logic and memory chips. We're talking the 7 nanometer, 5 nanometer, 3 nanometer nodes, and whatever comes next.
Okay.
So since about 2019, their NXE models, the ones with a 0.33 numerical aperture, those have been in mass production. They're the backbone for these top-tier chips.
Right.
But ASML isn't just sitting still. In 2023, they introduced the next generation, High NA, much higher numerical aperture, 0.55. The first EXE 0.5000 prototypes, already delivered for development.
High NA. So that allows for even finer printing.
Exactly, paving the way for the next generation of even smaller, more powerful chips. It's a constant push.
And get this, you mentioned the cost. Each EUV machine can run around $150 million.
Yeah, about that. It really gives you a sense of the sheer complexity and specialization involved. It's just astronomical.
Okay, so that's the top end. Stepping down just a level, we have DUV, deep ultraviolet lithography. Still very advanced, I assume?
Oh, absolutely still advanced and still critical. The DUV category includes a range of systems. You've got the 193 nanometer wavelength machines. Those come in immersion and dry versions. That's ARF. And then the slightly older 248 nanometer or KRF systems.
Immersion. That's where they dip the wafer in water. Great.
Ultra pure water. Yeah.
Yeah.
Helps bend the light more, allows for finer patterns. ASML's twin scan family for immersion lithography, or RFI. That was the real workhorse before EUV took center stage. And it's still absolutely crucial for manufacturing many, many layers of today's chips.
Okay.
They also offer other DUV systems, the dry versions, even older I-line machines and refurbished systems too. Those are perfectly fine for making chips using more mature processes.
And you mentioned competitors here, Nikon and Canon.
Yes, in the DUV space, Nikon and Canon are competitors.
Mm.
But ASML has really pulled ahead in DUV as well.
How so?
Well, they made some very strategic, very aggressive investments in immersion technology back in the mid-2000s. And because of that, they now command over 70% of the global DUV market.
Wow, over 70% even in DV.
Yeah, that level of dominance, it has significant strategic implications. It gives them huge influence over pricing, technology roadmaps. Nikon and Canon still play a role, absolutely. But ASML's lead is substantial there, too.
But it's not just about selling the physical machines, is it? I think you mentioned ASML offers something more comprehensive.
Absolutely. They call it holistic lithography. Think of it as offering chip makers, well, basically the whole toolkit for this critical step.
Okay.
So alongside the scanners, ASML provides a whole suite of metrology and inspection solutions. These are tools that help chip makers with things like precisely lining up the patterns on each layer, finding any tiny flaws, checking the overall quality. It helps their customers maximize yield, maximize performance.
Right, making sure more of the chips actually work properly.
Exactly. Fewer defects, better chips. And to really build out this whole integrated ecosystem, ASML has made some key acquisitions over the years.
Ah, right, like who?
Well, they bought HMI, Hermes Microvision, back in 2016. That significantly boosted their electron beam inspection capabilities, super important for finding those incredibly small defects. Then there was Brion, which specializes in computational lithography software. There's basically simulating and optimizing the whole process on a computer before you even expose the silicon. Saves a lot of time and money.
Smart.
And a really crucial early one was Cymer in 2013. They provided the leading laser sources, which are, a vital heart component of the lithography machines themselves.
So it sounds like they're really trying to make the whole process as seamless and efficient as possible for their customers, like a one-stop shop for lithography.
Precisely.
Yeah.
And this integrated approach, it also leads to recurring revenue streams. Think about it. Once these incredibly complex machines are installed,
Then you're looking after.
exactly. They need performance upgrades to stay cutting edge. They need regular calibration for precision, ongoing maintenance to keep them running 24/7. That's a significant and pretty stable part of ASML's business.
Now, when we talk about ASML, we usually just hear ASML. Do they have other brand names people might recognize?
That's true. While ASML is the main brand, you might come across the TwinScan family name for their scanners, the NXE and EXE designations for the EUV systems, and YieldStar for their metrology equipment. Those are probably the main ones.
Okay. And we absolutely cannot forget the crucial partnerships ASML relies on, right? This
Yeah.
isn't something they do completely alone.
Absolutely vital. In particular, their close collaboration with Carl Zeiss SMT in Germany. It's fundamental.
Zeiss, the optics company.
The very same, but a highly specialized division. Zeiss SMT is the exclusive provider of the ultra-precise optics and mirrors that are just essential for the EUV systems. You can't have EUV without those mirrors.
Oh.
So it really forms kind of de facto technological duopoly in that critical area. Neither could really do EUV without the other. It's a deep, deep partnership.
Okay, so that's the business model, the products. A really complex picture. Let's zoom out now and look at ASML's current situation. How are things looking as we sit here in, say, early 2025?
Right, so as of 2025, ASML is still in a phase of, let's call it, sustained expansion. Although maybe the truly explosive growth we saw right after the pandemic is moderated a bit.
Okay.
They still hit record sales in 2024, reaching $28.263 billion. And crucially, with a very healthy gross margin, around 51%. This amazing profitability is not just numbers on a page. It's proof of their irreplaceable tech, and it lets them reinvest heavily to stay ahead. It's a virtuous cycle.
But I remember you saying the growth in 2024 wasn't as high as 2023.
Correct. The revenue growth in 2024 was more modest, about 3%, compared to that massive 33% jump in 2023. But there's a bit more to this story there.
Oh.
Yeah, the fourth quarter of 2024 showed a really significant rebound. Quarterly revenue shot up to $9.263 million. That's a 28% increase year over year.
Wow, okay.
And the gross margin was strong too, 51.7%. And importantly, they saw a very strong influx of new orders. The backlog hit $7.088 million, which really smashed expectations.
So what does that tell us? Sounds like things picked back up strongly at the end of the year.
Exactly. That strong Q4 suggests a resurgence in demand for their machines. It seems like after a period where memory chip clients were kind of adjusting their inventories through 2023 and early 2024.
They're starting to invest again.
It looks like it.
Yeah.
Preparing for future demand, upgrading their tech.
And who are the big players buying these incredibly sophisticated, incredibly expensive machines?
Well, ASML's client list is basically a who's who of the semiconductor world. You've got TSMC in Taiwan,
Hmm.
and Samsung and SK Hynix in Korea, Intel and Micron in the U.S., among
Yeah,
others.
right.
However, 2024 saw a particularly high contribution from China. It accounted for around 41% of their annual sales.
41% from China. That seems surprisingly high. What was going on there?
Yeah, it was unusually high. That surge was mainly due to accelerated purchases of ASML's DUV equipment by Chinese manufacturers.
Trying to buy before restrictions kicked in.
Exactly. They were anticipating stricter trade restrictions being imposed. And those restrictions, led mainly by the U.S. and the Netherlands, they have indeed been in place since 2023. They prevent ASML from exporting its cutting-edge EUV machines to China, and they also limit some of the more advanced DUV sales.
So that 41% figure from China in 2024, probably a one-off spike.
Precisely. We'll likely see China's contribution in 2025 normalize back down to more typical levels, maybe around 20% of revenue, something like that.
Okay.
But despite these geopolitical headwinds, the underlying global demand for ASML's equipment still really robust. It's
Yeah.
fueled by that ongoing transition to even more advanced process tech, think 3-nanometer next-gen DRAM, plus all these new fabrication plant projects popping up globally, often with government backing.
And it seems like there's maybe a shift happening in what's driving that demand, something about AI.
That's a key point, yeah.
Hmm.
ASML's own management has talked about this, attributing some recent order volatility to shift in market dynamics. Basically, the rapid rise of artificial intelligence is now a major driving force behind investments in high-performance chips.
Right, the GPUs and specialized AI chips.
Exactly. And this trend is primarily benefiting the logic chip manufacturers, the companies making CPUs, GPUs, AI ASICs, maybe more so right now than the memory chip makers, at least in the immediate term.
So the CEO himself is pointing to AI as the big growth engine going forward.
Pretty much. He's highlighted that AI presents both huge opportunities, obviously, more demand for the specialized equipment needed to make AI chips, but also some risks, like potential temporary imbalances between logic and memory demand.
Okay, so wrapping up this section on their current situation, it sounds like ASML is in a really strong spot, even with some market shifts.
Absolutely. They've got a high value-add business model, a dominant position in their critical niche, with EUV tech as the crown jewel. And as we move through 2025, they seem very well positioned to capitalize on huge trends like AI proliferation and that global push to expand chip manufacturing capacity.
All right, let's get into the financial nuts and bolts now. We've touched on revenue and margins, but what does the overall financial strength of ASML look like? How solid are they?
ASML's financial strength is frankly remarkable. Let's just look at their revenue growth over the last decade or so. They went from around, $6.3 billion in 2015 up to that record $28.263 billion in 2024.
That's incredible growth.
It's a phenomenal trajectory, really highlights the increasing importance of their technology, doesn't it?
Although we did see that recent slowdown in growth, right? The 2.6% in 2024.
Yes, that plus 2.6% growth in 2024, especially after the plus 30% jump in 2023, definitely reflects that cyclical dip in the memory market and those export restrictions we talked about. But the strong demand from logic clients and that rush from Chinese customers did provide a partial cushion, which shows some resilience from having a diverse customer base.
But their profitability, that seems to be the real standout feature, those margins.
Indeed. Their gross margin has been consistently high, very stable, hovering around 50-52%. In 2024, it was 51.3%, almost identical to the year before.
And that's much higher than other equipment makers.
Significantly higher. Most other semiconductor equipment manufacturers are typically around, say, 47%. This really underscores ASML's pricing power, which is a direct result of their unique tech position. They can charge a premium.
And I assume that strong gross margin translates down the income statement to operating and net margins.
Correct. Their operating margin in 2024 was a very healthy 31.9%, and that's after significant investments in R&D. They pour about 14% of their sales right back into research.
Which they have to do, right?
Yeah.
To stay ahead.
Absolutely crucial for maintaining that technological lead, widening their competitive moat. And that's also after covering their selling, general, and admin costs. Their net income in 2024 was $7.572 million, giving a net margin of 26.8%.
Slightly lower than 2023, you said?
Yeah, slightly down from 28.4% in 2023, partly due to a higher tax rate. But generally, their net profitability has been in that very, very lucrative 25-28% range. It just shows the fundamental strength of their business model.
So what's really driving these consistently high margins? Is it just the EUV monopoly?
That's a big part of it. but several factors contribute. Increasing efficiency in manufacturing, especially as they scale up EUV production that brings economies of scale.
Mm-hmm.
Also, their product mix has become more favorable over time with higher sales of those very expensive EUV systems and their high-margin services. And yes, of course, the lack of any real competition in EUV means they don't face pressure to cut prices. They essentially set the market price for that technology.
It's interesting you mentioned that even early on with EUV, the margins were a bit lower. Takes time to get efficient, I guess.
Exactly. In those initial years, maybe 2017, 2018, the margins on EUV were a bit compressed. You had significant costs in developing and delivering a brand new, incredibly complex technology. But as EUV production matured and the volumes increased, the profitability of those systems improved dramatically. Shows they can learn and optimize.
And what about those upgrades and enhancements for machines already out there? That must be pretty profitable too.
Absolutely. Revenue from upgrades and enhancements has been growing steadily. These often have very low marginal costs, right? The R&D is done, so they contribute quite nicely to that already healthy gross margin. It's basically leveraging their massive installed base for additional high-quality revenue.
So the bottom line here really is ASML is a financial powerhouse.
Precisely. Strong sales growth, high and stable margins, leading to exceptional profit generation, and metrics like return on invested capital, estimated around 25–30% recently, are significantly above their cost of capital. That means they're consistently creating significant value for their shareholders.
Now, even though ASML is clearly knowledge intensive, they still need to build these massive complex machines. They must have some significant capital expenditure, or CapEx needs, right?
That's correct. While they aren't running giant chip fabs themselves, ASML does require substantial capital investment for manufacturing their systems and expanding production capacity. Back in 2022, their net outflows for investment were around $1 billion. That increased quite a bit to roughly $2.6 billion in both 2023 and 2024.
Okay, $2.6 billion in 2024. What percentage of revenue is that?
In 2024, that $2.609 million in total CapEx was about 9% of their revenue. So significant, but maybe not astronomical compared to, say, a chip fab's CapEx.
And where is that money primarily going? Expanding factories?
Primarily, yes. Expanding and modernizing their facilities, especially if their headquarters in Veldhoven, Netherlands. They're also investing in equipment to increase their machine assembly capacity, particularly for EUV systems, and potentially making strategic investments in their supply chain to secure critical components.
Right, securing the supply chain is crucial.
Hugely important. We also saw that collaboration with Zeiss, including co-financing some cutting-edge optics factories for next-gen EUV. That shows how deep these partnerships run.
So it sounds like a lot of spending, but maybe manageable given their size and profitability.
Exactly. ASML has managed to grow without needing these absolutely disproportionate mega CapEx projects, partly because of their fabless model for key components.
Ah, right. Zeiss makes the optics. Cymer, now part of ASML, makes the light sources.
Exactly. Many complex subsystems come from specialized partners. ASML focuses on the integration, final assembly, and testing in their huge clean rooms. However, they have flagged that we should expect some incremental investments in the second half of this decade to support the production of the next-gen high-NA EUV systems at higher volumes.
Makes sense.
But even with that, ASML is confident they can nearly double their revenue by 2030, hitting that $44–60 billion range with manageable organic investments and staying disciplined on capital spending.
Okay, let's talk about the operational side a bit more. How does their working capital cycle look? Selling such expensive machines with long build times must tie up a lot of cash, right?
It definitely has a big impact. The nature of their business, selling high-value gear with long manufacturing lead times, sometimes 12 to 18 months for the complex systems.
Yeah, that's a long time.
It is. And it naturally leads to a relatively high level of inventory. At the end of 2024, it's estimated they had around 230 days of inventory.
Wow, 230 days. That's like 8 months of their cost of sales.
Roughly, yeah. Tied up in work in progress, component stock.
Yeah.
And that was actually an increase from 2023, partly due to that sales slowdown and also some intentional inventory building to buffer against supply chain issues they'd seen earlier.
That sounds like a huge amount of capital tied up. How do they manage that?
Well, they manage their cash cycle quite efficiently, actually. A big part of it is leveraging advance payments from customers.
Ah, so customers pay up front.
Often, yes. Or significant milestone payments when orders are placed. Given the sheer size of these deals, hundreds of millions, that's common practice. And they also have the negotiating power to get favorable, longer payment terms with their strategic suppliers.
Okay, so cash comes in early from customers, goes out later to suppliers.
Exactly. So as a result, their cash conversion cycle, the time between paying suppliers and getting paid by customers, adjusted for inventory, has remained relatively stable, around 230 to 250 days. Interestingly, their net working capital can even dip slightly negative sometimes.
Meaning they're basically being financed by their suppliers and customers.
Partially, yes. At the end of 2024, their net working capital was estimated around minus $978 million. So those customer prepayments are absolutely key.
Right.
Chip makers view these machines as critical long-term investments, so they generally stick to their orders even during downturns. Plus, with that dominant market share, ASML doesn't really face competitors trying to undercut them with crazy discounts during recessions. Customers need their machines. They plan years ahead. So while the high inventory does lengthen the operating cycle on paper, their smart management of collections and payments keeps the cash flowing healthily. Growth doesn't just eat up all their cash.
That leads perfectly into free cash flow then. How has ASML actually performed in terms of generating cold, hard cash?
Their cash generation has been really robust, growing right alongside their profits. In 2024, their operating cash flow was very strong, $11.166 million. That's significantly higher than their net income of $7.572 million.
Why the big difference?
That was largely supported by a net reduction in working capital in 2024. Remember that inventory buildup? They started releasing some of that, maybe $3-4 billion worth.
Ah, okay. So less cash tied up in inventory.
Exactly. So you take that $11.166 million in operating cash flow, subtract the capex of $2.609 million, and you get a free cash flow for 2024 of around $8.557 million.
That sounds very healthy.
It is. It represents a notable free cash flow yield on their sales, around 30%, and on their market cap, maybe 3.8%. Now, 2023 was more moderate, around $2.754 million free cash flow, because working capital needs were higher then. But typically, the company converts a high proportion of its profit into free cash flow. They build up a huge cash pile during 2020-2022, which gives them enormous strategic flexibility.
And what does ASML typically do with all this free cash?
Primarily two things: rewarding shareholders and securing their future technology growth through R&D and strategic investments.
Okay, so shareholder rewards, dividends, buybacks.
Both. They have a policy of increasing their dividend each year, which signals confidence. For 2024, they proposed a total dividend of 6.40 euro per share, up about 5% from 2023. That's a total payout of roughly 2.5 euro, 2.6 billion, around a third of their profit.
Okay.
And they also actively do share repurchase programs. Between 2022 and 2023, they executed a big 12 billion program, using over 7 billion in 2022 and another 3 billion in 2023.
But I think I saw they paused the buybacks in Q4 2024. Any reason?
Yeah, that pause was likely just some caution given market volatility at the time.
Yeah.
But the company has said they intend to continue combining growing dividends with share buybacks as their long-term way of returning capital.
Makes sense.
And given that their projected free cash flow easily covers their R&D, their capex, and their dividends, they can do all this while still building cash or buying back shares. It really reinforces that high-quality investment profile. They don't need outside funding for their core operations or growth.
Let's touch on debt then. You'd think a company dealing with such expensive equipment and huge R&D might carry a lot of debt, but based on the cash flow, maybe not.
You'd think so, but interestingly, ASML maintains a very, very healthy balance sheet regarding debt. At the end of 2024, they had a substantial $12.736 million in cash and equivalents on hand.
Wow, almost $13 billion in cash.
Yeah, and total financial debt was only around $4.994 million. So doing the math, they actually have a net cash position of close to $7.7 billion.
So they have way more cash than debt. That's an incredibly comfortable position.
Absolutely. Their gross debt is mainly just some long-term corporate bonds issued in euros and US dollars. They basically took advantage of low interest rates in the past to maybe finance some buybacks or for general corporate purposes, optimizing things.
Right.
But this debt is well-structured, long-term maturities, and represents very low leverage compared to their earnings. Their debt-to-EBITDA ratio is way below 0.5x. Their shareholders' equity was over $18 billion in 2024, so strong solvency too. Debt to equity around 0.27x, interest coverage easily above 50 times.
So basically, they're not relying on debt at all to fuel operations or growth.
Exactly. Management is conservative. Debt is used opportunistically, maybe to optimize the capital structure, like with that 2022 bond for buybacks, rather than out of any necessity. Their high credit rating, A+ from S&P reflects this low financial risk. They could pay off all their debt tomorrow if they wanted, but they probably prefer maintaining an efficient capital structure with some low-cost debt.
Okay, now a company so deeply embedded in a notoriously cyclical industry like semiconductors, they must have faced some serious headwinds during economic downturns. How has ASML historically behaved in times of crisis?
That's a really crucial question, because while ASML definitely benefits from strong long-term secular trends, yet its business isn't immune to the semiconductor industry's ups and downs or broader macro crises.
Right.
Historically, big recessions or downturns in the chip investment cycle have led to pretty significant reductions in their orders, and usually to a lesser extent, their revenues. But what's really remarkable is ASML's resilience and their ability to recover quickly. Often, they actually strengthen their position after a downturn.
Interesting. Can you give us some examples? Like what happened during the big one, the 2008-2009 financial crisis?
Oh yeah, that was a major test. Global investment in chip fabs just cratered. ASML's sales plummeted by roughly 50% between 2007 and 2009, dropped from about $3.8 billion down to $1.6 billion. They even recorded losses in some quarters in late 2008.
Ouch. Did they have to make big cuts?
They did implement temporary cost-cutting measures, yeah, including a workforce reduction of about 12%, something like 1,000 jobs. But the key is the crisis was relatively short-lived for them. As chip demand rebounded in 2010, driven by new PCs, the first smartphones emerging orders flooded back in, and ASML quickly regained profitability.
And crucially, did they lose ground to competitors?
No, and that's important. They didn't lose market share. Customers basically just postponed purchases. They didn't switch to Nikon or Canon, who were also scaling back anyway. By 2010-2011, ASML was growing vigorously again. It really showed how essential their equipment was for the industry's recovery.
Okay, what about more recently? There was a bit of a dip in 2019, wasn't there, after a memory boom?
Exactly. After a peak in memory chip investments in 2017-2018, the industry hit an oversupply of DRAM and NAND flash in 2019. That led to CapEx cuts.
Right.
So ASML saw a slowdown in orders that year. Their revenue was relatively flat, around $11.8 billion versus $10.9 billion the year before. But, critically, this was partially offset by the first significant sales of their EUV systems for logic chips, specifically for TSMC's 7-nanometer node. That EUV demand helped cushion the fall in DUV demand.
So even then, they stayed profitable.
Oh yes, they remained profitable and kept investing heavily in R&D despite the weakness in the memory market, show their long-term focus.
And then, of course, the roller coaster of the pandemic and the supply chain mess afterwards. How did ASML navigate that?
Well, initial fears in early 2020, obviously, but then demand for semiconductors for computing devices just surged in the second half. ASML managed the disruption relatively well, actually increased revenue by about 18% in 2020, despite all the logistical headaches in their complex global supply chain.
Impressive.
The real test maybe came post-pandemic, 2022, 2023. You had chip shortages, then inventory adjustments across the industry. In 2022, ASML actually faced some limitations in supplying all the demand because of component bottlenecks, but still grew revenue 14%.
Great.
Then in 2023, that memory market correction hit again, reducing new orders. That was really visible in that Q3 2024 bookings drop, which spooked the market a bit.
I remember that.
But then, the rapid recovery of orders in Q4 2024, over $7 billion, indicated a return to the upward cycle, driven largely now by AI and high-performance computing chip investments. And through all this turbulence, ASML remained highly profitable. Net margins stayed above 25% even during that 2023-24 bump. They continued their dividend plans, their R&D plans, without major changes, just highlights their financial stability.
So the consistent theme really is resilience.
Precisely. ASML has consistently shown resilience during crises. It's supported by that technological monopoly and the fact that lithography investment, while postponable, is ultimately indispensable for advancing chip tech. Revenue might dip or stagnate temporarily, but the company typically stays profitable operationally, with very few exceptions, and they tend to emerge stronger.
And their market share helps protect them.
Definitely. Their dominance prevents destructive price wars in recessions. Customers tend to just resume orders as soon as end demand improves. Plus, ASML usually has a significant order backlog, often covering nearly a year of future production, which gives them a crucial buffer against short-term dips. So while the stock price can bounce around, fundamentally, the company keeps generating value through the cycles because of those strong competitive advantages.
Okay, let's pivot now to the bigger picture.
Yeah.
The overall market ASML operates in. What does the semiconductor market landscape look like, and what are the growth expectations?
Right, the global semiconductor market is definitely on a strong structural growth path. ASML itself estimates that worldwide chip sales could top $1 trillion by 2030.
$1 trillion. Wow.
Yeah, it implies a compound annual growth rate, or a CAGR, of around 9% between now, 2025, and 2030. And this isn't just ASML saying this. Industry analysts generally agree. It reflects semiconductors just getting embedded in everything: EVs, IoT, AI, 5G, cloud, you name it.
So to put that in perspective, what were sales like recently?
Around $600 billion in 2024. So reaching a trillion by 2030 means nearly doubling the market in just 6 years. It's massive growth.
And how does the market for the equipment making these chips, the wafer fab equipment or WFE market track with
Yeah.
this?
The WFE market basically grows in tandem with investments in production capacity. It hit a record high near $100 billion back in 2022. Then it dipped a bit in 2023 to around $87 billion because of that memory market contraction.
But it's expected to bounce back.
Oh yeah, projected to rebound to new record levels in 2024-2025. The industry association SEMI thinks WFE sales could hit around $113 billion in 2024. That's up 6.5% year over year, and keep growing to $121 billion in 2025. Maybe $139 billion in 2026.
So that's like 7-8% annual growth in the short term for equipment.
Roughly, yeah. Driven by reactivating memory investments and keeping the pedal down on logic investments.
And where does lithography, ASML's playground, fit within this WFE market? How big a slice is it?
Lithography is one of the largest and most critical slices. Litho equipment typically accounts for something like 20–25% of the total equipment cost for a new fab. That's mainly because the unit cost of these machines is just so high.
Right, that $150 million price tag adds up.
It really does. So it's estimated the whole lithography equipment market reached maybe $25–30 billion in 2023, including DUV and EUV, new and used. And ASML, with its $28 billion in sales in 2024, which also includes services and metrology, remember, clearly dominates this space.
And the outlook for the litho market itself?
Growing. Analyst projections suggest the litho market could grow to maybe $55 billion by 2032, implying a CAGR around 7–8%. And ASML itself expects double-digit annual growth just in EUV lithography investment for both logic and DRAM between now and 2030.
So EUV will grow faster than the rest of litho?
Definitely. It strongly suggests that within lithography, the EUV portion 100% ASML's market will have the highest growth. The more mature DUV tech will see slower growth, maybe even stagnation in the older legacy nodes.
So summing up the market outlook for ASML sounds very positive overall.
Indeed. Total semiconductor demand projected around 9% annually. That drives equipment investment at maybe 6–8% annually. And ASML's own revenue projections reflect that optimism. Guidance of $30–35 billion for 2025, potential range of $44–60 billion by 2030. That's an implied CAGR of maybe 8–11% for ASML itself between 2025 and 2030.
Pretty strong numbers.
Yeah, based on continued robust demand, especially for EUV and high-NA adoption, assuming no major disruptions hit the industry.
Let's break that market down a bit more. You mentioned logic and memory chip makers. How do those different segments impact ASML's business? Are they equally important?
ASML primarily serves those two main groups. Logic chip makers think microprocessors, AI chips, GPUs, SoCs, made by foundries like TSMC or IDMs like Intel, and memory chip makers, DRAM, NAND flash, from players like Samsung, SK Hynix, Micron.
Okay.
And the key thing is the demand for ASML's equipment from these two segments tends to be cyclical, and often they're out of sync. When memory is booming, logic might be cooling or vice versa. That actually creates some natural balance in ASML's overall demand profile.
Right, so let's start with logic and foundry. That seems to have been the big driver for ASML recently.
It has, yeah. Logic Foundry was the primary growth engine for ASML in recent years, accounting for maybe 60–70% of their system sales in 2022 and 2023.
Did that change in 2024?
It dipped slightly as a percentage because memory orders picked up, but Logic still contributed around 61% of system sales in Q4. The demand here is really driven by that relentless push to more advanced nodes. 5mm, 3nm, soon 2nm. Companies like TSMC, Samsung, Intel are just pouring money into EUV and immersion litho for these nodes.
Like TSMC buying loads of EUV for 5mm and 3nm.
Exactly. TSMC was a massive buyer from 2020. 2022 became ASML's single biggest customer. Now, there was a bit of a pause in foundry spending overall in 2024. ASML reported about a 17% decline in logic systems revenue for the full year compared to 2023. Some softness in mobile, maybe.
But new applications like AI are taking over.
That's the expectation. Growth in logic is expected to resume in 2025, fueled by the ramp-up of 2nm, 1.8nm nodes, and just the sheer need for more data center and AI chips.
Okay, and what about the other side, memory? DRAM and NAND flash makers.
Memory has historically been much more volatile. Remember that peak investment in 2017-18, followed by sharp spending cuts in 2019 and again in 2022-2023 because of global memory oversupply.
Right, so orders for ASML gear fell then.
They did, but we saw that significant recovery in late 2024. Q4 system sales to memory clients jumped 43% year over year, hitting $2.8 billion for the quarter, making up 39% of system sales.
What drove that memory rebound?
Mainly technology transitions in DRAM new nodes starting to require EUV and also expectations of memory prices recovering. ASML confirmed memory contributed more in 2024 and expects maybe flat growth for the segment in 2025, so staying at those stronger levels.
In longer term for memory?
Medium-term, memory will be an important growth driver. EUV is really penetrating advanced DRAM manufacturing now. Samsung, SK Hynix are adopting EUV for multiple layers in new DDR5 memory. That requires more EUV machines.
Ah, so more EUV needed for memory too.
Yes. ASML projects double-digit CAGR in EUV spending just for DRAM through 2030. So
Yeah.
memory could actually grow from its current 30% of the mix to a larger slice in the coming years, which would give ASML a more balanced revenue stream.
Are there any other significant segments for ASML beyond logic and memory?
Yeah, a smaller slice of revenue comes from specialized applications and manufacturers using more mature process nodes.
Like what kind of chips?
Think analog chips, sensors, microcontrollers, power management chips. These typically use tech at 28 millimeters or older, so they don't need EUV. They use DUV dry or even older kit.
And ASML sells into that market too.
They do, along with Canon and Nikon. They supply new or refurbished machines for this legacy node market. Growth here is modest but stable, tied to more chips going into cars, basic IoT devices, industrial stuff.
Okay. What about all these new government-backed fabs being built, Chip Act and all that?
Good point. That's another opportunity. Many of these new fabs, especially initially, will focus on mature tech, maybe 28-45 millimeter.
Okay.
That could lead to more sales of ASML's DUV RF scanners.
And advanced packaging. Chiplets.
That's an interesting area. It doesn't use traditional wafer lithography, but ASML has explored related tech like nano-imprint lithography through its stake in IMS. Could be relevant for future integration methods, but it's not a significant revenue driver right now.
So looking ahead for 2025.
2025 looks like a recovery year for logic spending and a solid base for memory. Analysts expect more logic investment for AI and 32-millimeter capacity, while memory focuses on tech upgrades rather than just adding huge capacity, trying to avoid another oversupply glut.
And that explains ASML's wide guidance range for 2025 revenue growth, +6% to +24%. Uncertainty about memory timing.
Exactly. Some memory clients might push bigger orders into 2026 depending on price trends. But beyond 2025, both logic and memory have really solid drivers.
Yeah.
Logic needs more performance. Memory follows because faster logic needs faster memory and more storage.
Okay, it sounds like there are a lot of powerful underlying trends supporting growth in this whole sector.
Absolutely. Several major macro and tech trends are fueling semiconductor growth and therefore the demand for ASML's equipment.
Let's start with the big one everyone's talking about, artificial intelligence.
Right. The explosion of generative AI, machine learning, big data analytics, it's creating a massive demand for specialized hardware. AI data centers need advanced GPUs, dedicated AI chips, all requiring the most cutting-edge manufacturing nodes.
Which means EUV from ASML.
Directly benefits ASML. No top-tier AI chip gets made without their EUV gear. And as AI expands further, autonomous vehicles, robotics, cloud services, the demand for advanced chips could easily exceed current forecasts. It's a huge potential catalyst.
And just the continued growth of cloud computing and 5G networks must still be a big factor too.
Indeed. The ongoing move to the cloud, streaming, social media that keeps demand high for servers and data centers needing advanced processors and memory. Plus, 5G rollouts and soon 6G drive renewal of telecom infrastructure and compatible devices.
So that requires a whole range of chips.
A wide range, yeah. From 5mm server CPUs down to RF modems, power management chips, sustaining pretty diversified growth. For ASML, that means there's a market for both their leading-edge EUV and their intermediate DUV node solutions.
What about things like industrial automation, the Internet of Things? Less advanced maybe, but growing.
Definitely going. The digitization of traditional industries, Industry 4.0, smart cities, precision agriculture involves deploying massive numbers of sensors, connected microcontrollers, IoT, power chips.
And many of those use older tech.
Often, yes.
Yeah.
Mature processes. But the sheer volume keeps older fabs busy and eventually creates the need for new fabs for these specialized chips. ASML can sell refurbished or new DUV kit into this segment, And don't forget, automotive cars are becoming computers on wheels. More chips for battery management, ADS, infotainment sensors. Autonomous driving needs both advanced chips and lots of secondary components.
We also touched on government support HEPS Act, EU plans. How big an impact is that having?
It's significant. Those 2020-21 chip shortages really spurred governments into action to boost local manufacturing. The U.S. Chips Act, the EU's plan, China's existing heavy investment. It's all leading to numerous new fab projects globally.
So TSMC, Samsung, Intel building in the US and Europe.
Right, plus domestic efforts in Japan, India, considering it. Even if not all these fabs are commercially optimal, in the short term they mean guaranteed equipment orders. Hundreds of billions earmarked for gear in the coming years.
And ASML benefits regardless of who builds.
Pretty much. As a strategic supplier, any new Intel or TSMC megafab means dozens of ASML scanner orders. Plus, this regionalization push might actually create some redundancy, more global fabs built for geopolitical reasons, potentially increasing the total market for equipment slightly.
And finally, just the sheer complexity of making chips keeps increasing, right? Moore's Law isn't dead yet.
Not dead, maybe just evolving. But yes, the push continues. Each new chip generation requires more complex manufacturing, often more lithography steps per wafer, maybe multi-patterning into EUV, or just more layers needing EUV.
Which means more machines needed.
More litho tools needed per fab, or per layer, exactly.
Yeah.
For example, maybe a 7nm node uses 4 or 5 EUV layers, but a 3nm node uses 8-10 EUV layers. That increases scanner demand.
And high-NA EUV coming online?
Right, high-NA aims to simplify things for sub-2nm nodes, needing less multi-patterning. But those machines will cost even more, maybe over $300 million, and will likely complement, not fully replace, current EUV. So the trend is towards more value invested per wafer processed. That benefits leading suppliers like ASML.
So overall, the sector outlook looks pretty bright, despite bumps.
Yeah, after the 2023 correction, a new growth cycle seems underway from 2024-2025, supported by AI, 5G, memory normalization. Forecasts point back to high single-digit or moderate double-digit growth. Risks remain, of course, cycles haven't disappeared, geopolitics, maybe physical limits eventually. But ASML starts with strong tailwinds and a privileged position to capture most litho spending through 2030.
Okay, now to get an even better feel for ASML's unique position, it's really helpful to look at its competitors and maybe some other comparable companies in the semiconductor world. Who are ASML's main rivals, specifically in lithography?
Right, so ASML's primary competitors in semiconductor lithography are the Japanese companies Nikon and Canon, although, honestly, ASML's current leadership is so pronounced, the competitive landscape feels pretty lopsided right now.
Let's start with Nikon. They used to be a really big player back in the day, didn't they?
They absolutely were. Back in the 90s, early 2000s, Nikon was a very strong competitor, even dominated parts of the litho scanner market, especially eyeline and KRF tech.
So what happened? How did ASML overtake them?
The big turning point was immersion lithography. ASML introduced RF immersion earlier and arguably more successfully around 2004, 2006, and that really put them ahead.
And where does Nikon stand now?
Well, Nikon still has its precision equipment division making DUV litho gear, RF immersion, RF dry, eyeline, and also equipment for flat panel displays. But, and this is absolutely critical, Nikon does not develop EUV systems.
No EUV at all.
No, that was a strategic decision that essentially left them out of the most advanced, highest growth segment. So Nikon's market share in semiconductor litho has shrunk down to maybe 10–20% in DUV, and basically zero in leading-edge nodes.
So who buys Nikon scanners today?
Typically manufacturers using more mature processes, say 28nm or older, or maybe some DRAM lines still using immersion for less critical layers. Some fabs in China, for example, buy Nikon RF scanners for 90 down to 28nm stuff.
And financially, how does Nikon's litho business compare to ASML's?
Oh, it's much, much smaller. In their 2023 fiscal year, Nikon's whole precision unit, including semiconductors and displays, billed around $1.6 billion. That's just a fraction of ASML's $30+ billion. And Nikon Precision's profitability is modest, maybe 5–10% operating margin, way below ASML's 32%. It shows the disadvantages of scale and product offering.
So ASML just outguns them on tech and scale.
Pretty much. EUV is the big one, but also advanced software, economies of scale in production, and just those deep relationships with the top clients. Nikon still has know-how in optics and makes quality scanners for certain niches, but they just don't have the complete package for the leading edge.
Okay, and what about Canon? Are they a bigger threat?
Canon also makes DUV litho equipment, but their focus has been even more on specialized machines, like systems for larger chips, power semiconductors, or alternative tech like nanoimprint lithography through a subsidiary.
So not really competing head-on in high-volume logic memory.
No, Canon has a pretty marginal share in high-volume IC litho. They kind of stopped chasing the leading edge some time ago. Their participation is more limited to I-line, KRF for mature applications, or maybe competing in segments like MEMS or sensors where less advanced gear works.
And like Nikon, no EUV.
Correct. No EUV from Canon either. And since Canon is this huge, diversified conglomerate, cameras, printers, medical gear, their semiconductor equipment business is a pretty small part of their overall picture. Their industrial unit, which includes litho, had sales around $1.3 billion in 2022.
So what's the fundamental difference then? Why did ASML succeed where Nikon and Canon seemingly couldn't, especially with EUV?
It really boils down to that massive long-term technological bet. ASML invested over 2 decades, spent more than $6 billion developing EUV, and crucially, they had support from customers and governments who saw its importance.
And Nikon and Canon didn't make that same bet.
They didn't match that commitment. Maybe too risky, too technically challenging, who knows. But the result is ASML now has 100% of the EUV market and over 70% of the total litho market.
Which gives them huge advantages.
Massive economies of scale. They can spend more on R&D than Nikon and Canon combined and still have higher margins. It's basically created a natural monopoly for them in the most advanced segment, likely for the next decade.
And competitors can't just undercut them on price.
Not really for leading edge. Those clients won't sacrifice the necessary EUV tech for marginal savings. They need EUV, and only ASML has it. And as we said, even in downturns, Nikon and Canon don't really have the capacity to disrupt the market.
Is there any chance Nikon or Canon could catch up? Or maybe someone else, like in China?
Highly unlikely in the foreseeable future. Nikon announced some research into next-gen high-NA EUV with universities, but anything resulting would likely be too late for the 2030 timeframe. China's trying with SME, aiming for 28mm DUV eventually, but catching up on EUV, that's an enormous leap. The IP, the physics, the specialized supply chain, it's incredibly hard for a credible rival to emerge in advanced litho this decade.
So basically, ASML faces only residual or niche competition in its main field.
Pretty much. Maintaining an almost impregnable advantage thanks to that unique tech and integrated ecosystem.
Okay, beyond direct litho competitors, who else in the broader semiconductor equipment sector, the WFE sector, might be useful to compare ASML against?
Right, if we broaden the view, companies like Applied Materials, AMAT, and Lam Research, LRCX, are good comparisons. They don't make litho tools, but they serve the same chip fab customers with machines for other critical steps: deposition, etch, implant, cleaning, etc. Comparing ASML with them highlights ASML's unique strengths.
Let's start with Applied Materials AMAT. They're huge, right? The biggest in WFE overall.
Excluding lithography, yes. Applied Materials is the largest WFE supplier by revenue. Their portfolio is incredibly broad deposition systems: CVD, PVD, etch, surface treatment, metrology, lots of stuff.
So they're more diversified than ASML.
Much more diversified in terms of process steps covered. Their revenue is relatively balanced between logic and memory clients. In their fiscal 2023, Applied hit record sales around $26.5 billion, actually pretty close to ASML size then. But growth was modest, plus 2%, as memory weakness offset foundry logic strength.
And how do their margins compare to ASML's?
Lower. AMAT's gross margin is about 47%, below ASML's 51%. That likely reflects the greater competition they face in their segments. They compete strongly with Lam, Tokyo Electron, KLA, etc. in each type of equipment.
Right. No monopoly for AMAT?
Exactly. Their operating margin was around 28-29% in 2024, net margin about 25%, also lower than ASML. So Applied's profitability is good, very respectable, but not quite at ASML's exceptional level, likely due to that more fragmented competition.
What are AMAT's strengths compared to ASML?
Well, that broad product base is a strength. If a client cuts litho spending but boosts deposition spending, AMAT can still capture some of that. They're less dependent on one single technology like EUV. They also have a strong presence in NAND flash equipment, where ASML sells less right now, and in refurbishment services. But again, no monopolies. They face tough rivals in every niche.
Okay, and what about Lam Research, LRCX? What's their specialty?
Lam Research specializes mainly in etching and deposition equipment, but they really excel in that process of removing material to define chip structures.
And they're big in memory.
Very big, especially in NAND flash. Their etch tools are critical for making those complex multi-layer 3D NAND memories. Because of that, their revenue took a hit in 2023 when memory spending dropped down to about $17.4 billion from $19 billion in 2022. Shows their higher exposure to memory cycles compared to ASML or even AMAT.
And Lam's margins, similar to Applied.
Yeah, pretty similar. Gross margin around 46–47%, net around 25%. Lam sometimes has slightly higher operating margins than Applied in good times, maybe 30% plus bowl, possibly due to their strength in key memory processes.
So more exposed to memory cycles, but strong within that niche.
Exactly. Lam invests heavily in R&D too, similar percentage of sales to ASML, 14–15%. But compared to ASML, Lam is much more dependent on that memory submarket. And critically, they don't have ASML's monopoly advantage either. They compete fiercely with Intel and Applied and Etch.
Which is why their valuation might be lower.
Probably contributes, yeah. Investors typically demand a premium for ASML's unique dominant position.
You mentioned Tel Tokyo Electron briefly. Where do they fit?
Telel is the big Japanese WFE player. Broad portfolio like Applied Deposition, Etch, Clean. Revenues around $12 billion in 2023, gross margins 44%. Also competitive. They do collaborate with ASML sometimes, like on integrating metrology with litho. But again, like Applied and Lam, Tello doesn't have any segment where they're the sole global supplier like ASML is in EUV.
So, boiling it down, what's the key difference between ASML and these other big WFE players?
The absolute key distinction is that ASML enjoys that near monopoly in the most complex, most expensive part of the WFE market leading-edge lithography. Applied, Lam, Tello compete hard amongst themselves in more fragmented segments.
Which gives ASML
Greater pricing power, longer-term order visibility, customers order EUV years ahead, and more protection in crises because there's no oversupply of scanners from competitors. Applied and Lam have historically seen more volatility in revenue and margins because of that rivalry. Remember 2009? Applied lost money operationally. ASML recovered faster.
and ASML's returns are better too.
Generally, yes. ROIC, 25–30% for ASML versus maybe 15–20% for Applied or Lam typically. ASML's relative cash generation is superior too, and this gets reflected in valuation multiples. ASML consistently trades at a higher PE and EV/EBITDA than the sector average, reflecting that quality and dominance premium.
And technologically, ASML kind of leads the way.
In a sense, yes. ASML's advances, like high-NA EUV, are game changers that enable the next chip nodes. Applied and Lam's tools are essential too, but they often follow the roadmap dictated by what lithography makes possible. So ASML's become arguably the most strategic WFE company. Its tech marks the limit of what can be made. No other WFE player really holds that status.
It's also really interesting to compare ASML not to competitors, but to its actual customers, the chip manufacturers themselves, like TSMC and Intel. They're also capital-intensive tech giants.
That's a very insightful comparison, yeah. Even though they're customers, not rivals, comparing them helps frame ASML's position in the value chain. Investors often weigh up investing in the fab versus the company selling tools to the fab.
Okay, let's start with TSMC. World's biggest foundry, makes chips for Apple, NVIDIA, everyone.
Right. TSMC had revenues around $75 billion in 2022, dipped slightly to $71 billion in 2023, but they have incredibly high margins for a manufacturer. Gross around 58%, net maybe 33–38% in recent years.
How do they manage that?
Through sheer scale and technological leadership. They're really the only ones who can reliably pump out huge volumes of 5mm and 3nm chips right now. But
There's a but.
their business is way more capital intensive than ASML's. In 2022, TSMC spent around $36 billion on CapEx. That's almost 50% of their sales. And they plan similar huge amounts going forward for new fabs.
So that eats into their free cash flow.
Significantly. Despite the high profits, their free cash flow is tighter, and their capital returns, while good, are maybe slightly lower than ASML's peak levels. ROE around 30%, ROIC maybe 20–25%.
And TSMC is more exposed to chip demand cycles.
Directly exposed. If there's an oversupply of certain chips, TSMC's factory utilization drops, and it hurts them immediately. ASML sells the tools, so they're a step removed, more diversified across clients and end markets.
Plus, the geopolitical risk for TSMC.
That's a big one. The concentration of their most advanced fabs in Taiwan is a major concern for investors given China-US tensions. Some definitely see ASML as a way to play the advanced chip trend without that specific Taiwan risk. And that's partly why ASML often trades at higher valuation multiples than TSMC. Perceived lower political and inventory cycle risk.
Okay, and what about comparing ASML to Intel? They're in a different situation right now.
Very different situation. Intel, historically the giant of PC server chips, has struggled recently, falling behind TSMC technologically. Their 7nm node faced delays, cost them leadership.
So they're trying to catch up.
Exactly. Intel is in a massive turnaround effort, investing hugely to regain tech leadership, that aggressive 5 nodes in 4 years roadmap, and also trying to become a major foundry, making chips for others.
Which means massive capex for Intel too.
Enormous capex, around $25 billion in 2022. plans for similar or larger amounts, partly funded by government subsidies like the GPS Act. But their recent financial performance has been weak. Revenues dropped sharply in 2022. They had net losses, only a slight recovery in 2023.
So comparing Intel and ASML financially, stark difference.
Huge difference right now. Intel has much lower margins, gross 42% in 2023, net barely positive, practically zero ROIC recently. Intel operates in hyper-competitive end markets, CPUs versus AMD, GPUs versus NVIDIA, and suffers when PC demand slumps or when they stumble technologically.
Whereas ASML sells the picks and shovels to everyone.
Exactly. ASML benefits whether Intel wins or TSMC wins or Samsung wins, as long as they're all investing in advanced manufacturing. In fact, if Intel succeeds in its turnaround, that means massive orders for ASML's EUV gear. Intel's already been a major EUV buyer since 2021.
So investing in ASML is kind of betting on the whole industry investing rather than picking the winner among chip makers.
That's a great way to put it. It's more of a positive-sum game for ASML versus the often zero-sum competition in chip sales.
So overall, ASML seems to have a more stable niche within this complex, capital-intensive industry.
I'd say so. They provide a unique, essential input that all leading producers need. TSMC and Intel compete on final products, costs, performance. ASML can set prices that ensure its profitability because its key offering has no substitutes.
But ASML still depends on its clients investing.
Absolutely. If Intel hit major financial trouble and stopped investing, or TSMC slashed CapEx dramatically, ASML would feel it. But so far, their client diversification has provided a good buffer against any single customer's problems having too large an impact.
One interesting metric you mentioned was R&D spend as a percentage of sales. ASML 14%, TSMC 8%, Intel 20%.
Yeah, Intel's is high, partly because sales fell. But it shows ASML, even as an equipment supplier, invests proportionally as much in innovation as a chip producer. Highlights the sheer complexity and R&D intensity of their technology.
So wrapping up these comparisons,
Compared to other capital-intensive players, ASML offers more stability in margins and growth because they sell a critical input, not competing in the final consumer market. Their risks are more tied to the industry's overall investment cycle and their own tech execution, which they lead, while TSMC and Intel have final market risk, design risk, competitive risk, geopolitical risk. For an investor, ASML is that picks and shovels play on the whole semiconductor boom, versus TSMC as a pure manufacturing play with Taiwan risk, or Intel as a riskier turnaround bet.
okay, let's try to bring all this together now. Based on everything we've discussed, what does a reasonable base case scenario look like for ASML's future, say, over the next few years? What are the projections?
All right, let's synthesize a base case projection, thinking as of early to mid-2025, using ASML's latest guidance and general analyst consensus. So ASML themselves guided for 2025 revenue between $30 billion and $35 billion. That's a growth of 6% to 24% over 2024.
That's a wide range. Where would a reasonable base case fall?
Let's take roughly the midpoint, maybe assuming around 15% revenue growth for 2025. That seems broadly in line with consensus estimates right now.
And what would drive that rebound?
It would be supported by that recovery and memory investment we talked about, especially DRAM needing more EUV, plus continued spending on advanced logic nodes as clients ramp up 3 nanometers and start moving towards 2 nanometers.
Okay, so 15% growth in 2025. What about beyond that, 2026, 2027?
Maybe anticipate high single-digit growth, say 10–12% annually, for 2026 and 2027, then potentially moderating a bit further out towards 2030. This kind of pace would align with ASML's own longer-term projections of reaching maybe $50 billion in revenue by 2030 in their medium scenario. External analysts like Morningstar also project similar growth rates for the next couple of years.
So what kind of actual revenue numbers are we talking about in this base case?
Okay, so for 2025, around $32.5 billion, give or take $500 million maybe. For 2026, perhaps $36 billion. And by 2027, hitting around $40 billion, assuming that 10–12% annual growth continues.
And these figures assume the high-end EUV rollout contributes.
Yeah, they incorporate the assumption that the next big tech replacement wave, the introduction of high-NA scanners into production, probably ramping up around 2026, 2027, will generate a bit of an upgrade cycle. Plus, remember, their growing installed base keeps driving service revenues. That was nearly $6.5 billion in 2024, about 23% of sales. We expect that to grow steadily, maybe 10% annually, providing that nice, recurring, high-margin flow.
Okay, and profitability. Can they maintain those impressive margins in this scenario?
ASML guided for a gross margin of 51–53% for 2025, so similar to current levels. Our base case could keep it around 52% in 2025, maybe with slight expansion in the following years.
Why would margins expand further?
Could be driven by better economies of scale as EUV volumes grow, the initial higher costs of the high-end A program stabilizing once it's industrialized, and just getting more high-margin service revenue in the mix.
ASML has some ambitious long-term margin targets, right?
They do. Their 2030 vision targets a gross margin of 56–60%. That implies significant expansion. Our base case might see them reach maybe 55% by 2030 if things go well.
Right.
But for 2025, 2027, let's stay conservative. Gross margin gradually creeping up from 52% towards maybe 54%.
And operating margin.
Should see slight improvement too. ASML will keep investing heavily in R&D in absolute terms, but maybe it drops slightly as a percentage of sales, perhaps towards 10–12% by 2030 from 14% now. So operating margin was 31.9% in 2024, maybe 32–33% in 2025, perhaps hitting 35% by 2027. That assumes operating expenses grow slower than sales once that big hiring wave moderates, getting some operating leverage.
And net margin follows.
Should follow the trend. Started on 27% in 2024, could rise to 28–29% in 2025, maybe approach 30% by 2027, assuming stable tax rates. Longer term, if they hit those gross margin targets and keep buying back shares, a net margin above 30% is definitely plausible.
And what about the balance sheet and cash flow under these projections? Still looking strong?
Oh yeah. With that kind of cash generation, ASML will likely keep accumulating net cash or just return more to shareholders via dividends and buybacks. Even assuming a similar payout ratio, they'll generate surpluses.
So that net cash position could get even bigger?
Likely, yes. By 2027, it could be significantly larger than the $7.7 billion at end 2024, unless they make a big acquisition, which seems unlikely right now. Fixed assets will grow moderately with CapEx, but remain a small part of the balance sheet. Working capital should stay under control. Debt could be refinanced or reduced.
Yeah.
Equity will grow substantially.
And cash flows.
Operating cash flow should keep rising, maybe $10–11 billion in 2025, scaling towards $12–13 billion by 2027. CapEx might increase slightly, maybe $3–3.5 billion annually by 2027 for capacity, but still stay under 10% of revenue. So free cash flow could stabilize around $89 billion per year in 2025–27, then grow from there. They're potentially generating something like $40 billion in cumulative SCF over the next 5 years. Huge flexibility.
And key indicators like ROIC.
Expected to remain strong, 25–30% range. ROE might dip slightly from recent highs but stay very healthy. Debt metrics remain negligible. Liquidity stays robust.
Okay, so putting it all together, what does this imply for ASML's valuation? It sounds great, but is it already priced in?
That's the million-dollar question, or rather the $226 billion question given their market cap. ASML currently trades around $575 per share. That gives a 2024 PE ratio near 30x.
Which is pretty high.
It is high in absolute terms, yes. But looking forward, based on 2025 projections, the forward PE drops to maybe around 25x earnings. Still not cheap, but arguably more justifiable given ASML's quality growth prospects and that dominant market position.
What are analysts saying?
Many analysts have 12-month price targets significantly above the current €570, often north of 700, some even higher. Relative to growth, the PEG ratio is maybe around 2, which isn't outrageous for a company with such a strong moat. Of course, there are risks to this scenario.
Right, downside risks.
Global recession hitting chip demand harder than expected. Delays or technical hiccups with high-end A machines, geopolitical escalation impacting trade or supply chains.
And ups and risks.
Stronger than expected AI demand, pulling forward even more EUV orders, maybe a surprise easing of restrictions on sales to China.
Okay, so based on all this incredibly detailed analysis, what's the core investment thesis for ASML right now? Why might someone invest?
The investment thesis really rests on a few key pillars. First, just the exceptional quality of the company and its durable competitive advantage.
The moat.
Exactly. That wide, sustainable moat from EUV technology. It gives them pricing power, gross margins 50%, high returns on capital, ROIC, way above cost, recurring service revenue, and that long secular growth runway tied to semiconductor demand. Their dominance is protected by huge tech barriers. The business model is almost irreplaceable in the chip supply chain. That provides unusual resilience.
Okay, quality and moat. What's second?
Growth potential and catalysts. Despite being huge, ASML still has significant growth avenues. The immediate one is that AI HPC investment cycle potentially accelerating EUV orders. A full memory market recovery is another catalyst. The commercial rollout of high-NA EUV in 2025–26 is key enabling next-gen chips, potentially triggering an upgrade cycle. And longer shot maybe, but any easing of China restrictions represents significant upside.
And third, how does the current valuation fit into the thesis?
Well, at 30x trailing earnings, ASML isn't objectively cheap. But the argument is it offers an attractive risk-reward profile, given the expected earnings growth, maybe 15% CAGR, and the security of its niche. The stock price has pulled back from previous highs, reflecting some of those transient fears about orders or cycles that now seem to be dissipating.
So an opportunity, perhaps.
Potentially, yeah. Investing now could capture a return to those peak levels and beyond over the next 1 to 2 years as growth reaccelerates. Many investment firms project double-digit annual returns, with price targets suggesting 20–40% upside is plausible. Plus, investors get that growing dividend, 1% yield, and intrinsic value boost from buybacks, 1–2% share reduction annually. Our base case EPS projections suggest a price well above 800 by 2027 is feasible even with a conservative 30x multiple.
So, practically speaking, how might an investor approach ASML? Is it a buy and hold or something else?
For many, ASML could be a core long-term portfolio holding. Focus on that high-quality tech exposure. Returns likely come from both earnings growth and potentially some multiple appreciation if confidence fully returns. More tactical traders might try to play the cycles, buying during fear troughs, but that's harder. The consensus view right now seems to be that current levels don't fully reflect the expected improvement in 2025, maybe providing a decent entry point for long-term investors.
And finally, just to be balanced, what are the key risks again, and maybe any positive factors the market isn't fully appreciating right now?
Okay, key risks. Dependence on a few huge clients, like TSMC is a big one. Potential for some unforeseen disruptive lithotech way down the line, though seems unlikely short term. And maybe slower than expected adoption of high-NA if costs are too high initially.
Right.
But on the positive side, things maybe not fully priced in. Perhaps the scale of AI chip demand is still underestimated. Maybe high-NA adoption happens faster. Geopolitical easing on China is always a possibility. And I think the market sometimes overlooks ASML's proven ability to manage downturns, stay profitable, and build that backlog for the rebound. That Q3 foot 24 order scare, followed by the Q4 foot 24 recovery, really showed how the market can overreact to temporary blips, which long-term investors can potentially use to their advantage.
Okay, so let's try to quickly reiterate the key takeaways from this really deep dive into ASML.
Yeah, I think we've really uncovered a company holding an incredibly dominant, strategically vital position in a critical expanding market. Their financial health is just remarkably robust, and the growth prospects ahead look compelling, especially with AI providing this massive new demand driver.
And it's so clear that really understanding ASML gives you this unique window into the future of all technology, doesn't it? And just that relentless pursuit of more and more powerful computing.
It really does, which actually raises a fascinating question for listeners to maybe ponder on their own.
Oh, go on.
Well, considering ASML's absolutely central role right now, what completely unforeseen disruptions, maybe breakthroughs in fundamental physics or manufacturing techniques, could possibly challenge its seemingly unassailable position way out in the future? And what might be the very subtle early signals we should look for that could indicate such a profound shift is starting in this vital industry.
That is a fascinating thought. What could disrupt the king? Some truly interesting points to consider there. Thank you so much for taking this incredibly detailed deep dive into the world of ASML with us today.
My pleasure. It's a fascinating company.
It really is. We hope this has given everyone listening a much clearer, more insightful understanding of this crucial company and the powerful forces shaping the future of, well, pretty much all the technology we rely on every single day. We definitely encourage you to continue exploring based on the knowledge we've unpacked today.